Hello friends and welcome to my YouTube channel Simply Stocks, and today I'm going to talk about Tata Motors, what needs to be done at these levels, whether one should buy at these levels or avoid it. So let's get started. First of all, a disclaimer that this is not a stock recommendation. People taking any position into any share that I talk about should do that with their own due diligence and research, and I'm not in favor or against any company that I talk about. Before I talk about Tata Motors, a small request that kindly support me on Patreon, and once you do that, it will help me grow the channel, help you also ask me questions in greater detail, and you can ask me one question every day. Once you get the $10 membership, you'll have access to my portfolio, my watch list, and whatever changes I make to my portfolio or watch list, you get it immediately, and I alert everyone immediately. And you can also have access to a lot of podcasts that I put up from every 1 or 2 days time. For detailed market or company talk or one-on-one discussion you want to have, you can directly email me and we can work things out. Now about Tata Motors. Established in 1945, Tata Motors makes passenger vehicles CVs along with tractors. Worldwide presence with big acquisitions in Europe, as we have known, with Jaguar, etc. It is the part of the Tata Group, and market cap is of around 35 40,000 crore, which has risen over a period of time. If you look at the financials, then these are the December numbers for Tata Motors. Sales have grown by around 6.5%, and profits surged by 64%. The debt is extremely high, and because of this profit surge, the stock went up appreciably from 180 to 100 levels all the way to where it was. Actually, it was closer to 100 rupees, and has gone up all the way to say 340, 350. A return on equity of 24%, nearly operating profit margin of 12%. There is decent promoter and institutional holding in the stock. So what aided numbers? Lower interest cost was the first thing. So interest burden had reduced. They have reduced a little bit of debt, but the debt overall has gone up appreciably. So you have to be wary of that fact. Higher domestic savvy sales and European sales increase. So remember that after the pandemic, sales started to improve and has been improving, and we have seen that. Domestic CV sales has also improved over the last 3 quarters, and the numbers have started trickling in. Other income has also increased, and there has been a sharp increase in other income, and that has aided the numbers on the bottom line. Plus, operational efficiency is seen with the Jaguar Land Rover numbers coming in, which was pretty good. Plus, there have been operational efficiency with respect to the manufacturing that they are doing, manufacturing of the vehicles, and the way they were doing. So operationally they have done really well, and the cost have reduced. So reduction in a lot of cost has led to the numbers getting improved, but one needs to be wary that now with the commodity prices rising, I think auto companies may feel the heat in the short term, in the next 3 to 6 months, and then when everything gets absorbed and passed on to the consumers, eventually the consumers are the losers finally. Once it is done, then only you can expect to see the numbers and the stock getting re-rated even further. Otherwise, I see a decline in the stock because of the commodity price rise. I believe the rise in commodity prices will have a definite negative effect on the stock prices of, or on the numbers of most of the auto companies. If you look at the performance, stock started the move at the beginning of the third quarter. The third quarter started in October, and that's where the move began, and has been surging since a low of 130. So that was what I was saying, that closer to 100, the stock went to, and after that we have seen a real surge in the stock, and we have seen the stock go from 130 all the way to 330, 340. So 2.5 times jump in less than 6 months, and now the stock is cooling off, and there has to be some kind of sanity that had to be restored in most of the stocks, and that is being done at the moment. So numbers may have turned around for the time being, and numbers may come out good in the coming quarters. But we have to be very wary of the fact that number of cases for the pandemic is increasing in India and abroad, and we are seeing that happening in Latin America, in some part of Europe, and some of the major European cities are having that issue, and most there have been localized lockdowns along the way. So these are concerning signs, and that's why the market is pretty jittery even today as I make this presentation. So I believe that if one is having a position, they could book partial profits here. If one is not having position, wait for declines. I'll talk about the technicals in a bit, but it seems like you cannot just buy and you make money on all stocks. It's not going to be that smooth going forward. Things will improve in the long run, so there's no doubt about it that things will get much better in the long run. But for the time being, I feel in the next probably 3 to 4 months we could see some amount of, you can say, up and down movement, extreme volatility with respect to these auto stocks. So bottom line has significantly recovered, and it will keep on looking better than what has been the performance earlier. So that is for sure there. But in spite of that, I believe that the stock has run up more than the fundamentals of the company as yet. So why I believe it is an avoid, and I would still not buy this stock. And first of all, the thing is that it is a complicated business. You have to understand how the numbers are going to fare in Europe, numbers are going to fare with Jaguar, Land Rover, etc., with other kind of products they are selling abroad. Compare that to a Maruti, in which you are pretty clear that okay, numbers are getting better, and you can see on the ground as to how things are looking. If things are looking really good, then you can go ahead and look at the stock price and probably equate it or compare it to the amount of, you can say, verb with respect to sales in Maruti. So I feel that better, simpler businesses earn you more money while you invest into those companies rather than buying into complicated businesses. Valuations are stretched at the moment, even at 280 290 rupees. I believe that valuations are stretched. One has to be extremely careful. Interest burden is still high. There is a cause for concern with respect to high debt, and I think one needs to have an understanding of the business completely before someone can get into the stock. European health situation may still hurt the firm badly, and we are seeing that happening. So localized lockdowns are taking place. There are issues with a number of, you can say, cities, and there are issues with sales numbers there. So sales could be up and down, so it's very difficult to track, and that is why it is an avoid. And there are many better options available: larger companies, passenger vehicle companies, two wheeler companies available, auto ancillary companies available, which might be better options rather than just going for this one. And stock has run up a lot in the short term, so buying at these levels, I would say, would be fraught with a lot of risk. With the stock going up 2.5 times, it has run up a lot. If you look at the technicals of the stock, there's strong resistance at 340. Currently, the stock is around 310, 311. It is maybe headed to 250 levels. A better level to buy, even if you buy into it, would be closer to 260, 265, or closer to 250 if you get it, rather than buying at these levels. So there's a good chance of a 15% correction from here. And avoid buying on an upsurge. Do not fall into the trap that okay, it is up 5 7%, let's buy it. Look for those levels to buy where there are support. So let it either decline or consolidate for few weeks, and then you buy. Yes, charts have improved on the overall basis. So I would still avoid the company. I think there are many leaders in the industry better to go with. So there are other companies that are available. So it can be extremely volatile. So I would still avoid the company. So as I mentioned, I would avoid the company basically because there are other options that are available, and there are leaders in the industry that are available at a decent valuation. There are two-wheeler companies There are aspirational companies, there are listed four-wheeler companies, passenger vehicle leaders who are available with an idea that the business is more simpler in nature. So this can be extremely volatile. So it is not an investment bet. Yet you can trade into the stock with buying at around 270, 265, keeping a stop loss at 250, looking for 330 like that for a 20-30% upsurge. But overall, over 3-5 years, if I have to invest, I won't pick this stock. I would pick something like the leader in four-wheeler or in two-wheelers, and have less than 5% exposure into such stocks. So this was my video on Tata Motors. Please like and subscribe my channel and hit the bell icon so that you can get my videos straight away when I post it. And kindly support me on Patreon. Thanks a lot for watching.